A few global indices are now trading at new all-time highs and others are steadily closing in on theirs. This is a highly critical level, one that is technically more complex than first meets the eye. Here are the 6 different ways the indices may react upon retesting these levels and what we can expect in each and every scenario. The US Nasdaq and the Danish OMXS30 have both surpassed their previous all-time highs and are now conquering steady new grounds. Several other global indices are gradually closing in on theirs. This manifests itself well as one stock after the other are currently hovering around at technical resistances while still displaying enough strength to possibly push above them. This ambivalence, indecisiveness and mixed signals are just the type of situations we want to avoid as swing traders. For how can we position ourselves successfully when not even the market itself knows where it's heading in the short term? That's right, we can't. That is why this top and the index's ultimate unfolding is absolutely critical. And before the market has settled on a clear direction, I will personally proceed with the utmost caution. And by direction, I simply mean whether the index will push above and stay above, or if it will run into issues while getting close to or retesting the all-time high. But first, not financial advice, and please like and subscribe. Now, I've recently talked at length about parabolic tendencies on the global indices. Those cards are still in play more than ever. However, if such euphoric ride were to be preceded by steep index corrections sweeping across the board, it may turn into a minor bloodbath for small and mid-cap stocks, as those tend to react much more fervently. For as I mentioned in the previous episode, if the index were to correct by some 5 to 15%, we may safely expect the average small and mid-cap stocks to correct somewhere between 15 and 40%. And of course, if the indices were to correct even more, we might see less of net worth boasting on social medias for some time to come. In that sense, this episode is highly relevant to any swing trader out there or any market participant who engages mainly in small and mid-cap stocks. Therefore, in this episode we will look closer at the different types of reactions we can expect once we approach the previous all-time high. And most importantly, we'll discuss how to best approach each individual scenario. For it might get shaky at the top and it might not be as binary as simply getting rejected or breaking above it. This may still end up being the case, however the markets have a nasty tendency of attacking us from whence we least expect it. That's why we need to come prepared. Here are the 6 different ways the index might interact with the all-time high once it gets there. 1. The index gets close enough but doesn't actually retest the top, after which it rolls over for a correction. This is a sneaky scenario as most people would expect the index to retest the all-time high before making its move, whatever that move might end up being. Instead, it feints any unprepared trader and stockholder by rapidly turning downwards a percent or two from the peak. Such outcome would indicate additional weakness as the price wouldn't have enough energy to push that final stretch. And if this scenario were to occur, do expect for a more severe correction to follow. This is the one scenario at which the index more than ever faces the risk of dropping all the way down to the minus 15% region, or possibly more. The good news though is that this outcome is fairly unlikely. However, if this setup of not retesting the all-time high were still to happen, you might need to prepare for small and mid-cap stocks to slam the basement floor. And on that very floor you'll also find every single penny stock moonboy and hooligan cringing in fetal positions whilst loudly cursing the market for being manipulated. 2. The index does reach the top at which it gets rejected for a correction. This is a likely scenario and one that might set the scene for a 5 to 15% correction. And after that correction it will give the all-time high another go or two, after which it faces strong chances of actually breaking through. Unless the midterm technical map were to dramatically change, I will personally treat such correction as a grand buying opportunity, as I don't expect the index to be done for now. For as mentioned in the Parabolic Market Ahead episode, the indices do show clear tendencies of a final exponential move to the upside. Not because the economy is strong, for it's certainly not, but rather because your senile uncle and the cleaning lady at your work are now day traders and penny stock pros who happily share their picks on Facebook and then proceed to troll and hooligan any skeptics and naysayers who dare question the sustainability of their newfound love childs. For in their world, the emperor wears the most exquisite and elaborate clothes. So, upon an all-time high rejection followed by a correction, any retest of the all-time high might either push through on the first or second try, or else there's a good chance we might see some sort of a formation creation in preparation for a parabolic move. And just to be clear, once that move is over with, ammunition and tinned food might be your next best investment and life insurance policy. The basic moral with an all-time high rejection followed by a correction is that we don't wish to have too much money on the line should this scenario play out, especially not in small and mid-cap stocks. 3. The index breaks above the all-time high, retraces and retests it from above as horizontal support. This scenario would be an immediate sign of strength that would pave the way for an aggressive move up and is exactly the outcome we've seen in the Danish OMXS30 index, after which it has taken off strongly. For to be honest with you, I'm not quite sure a correction below the all-time high is really needed to amass power for another move up. Looking at the weekly RSI, for example, it is rather perfectly positioned for a parabolic index move. Instead, a correction might rather be an attempt to shake out jumpy market participants. 4. The index breaks above the top and then gets rejected aggressively for a false out. In practice, this scenario would behave similarly to the previous one, at which the price gets rejected and then enters a correction. However, in this scenario, the market would succeed at tricking a lot of people and losing them a bunch of money. Painfully much, at least for small and mid-cap stocks holders, as the downwards move would likely be a violent one. This sure is a scenario you'd want to keep your guard up for, as it can and typically does happen rapidly and without warning, as you're drooling over your profits in euros, pounds, dollars, pesos, or whatever the fuck currency you trade in. The volatility that typically comes with a US presidential election sure adds to the likelihood of this scenario. And add to this peculiar equation a lying, bullying psychopath with dangerously much powers who calls his supporters to arms should he lose the election, and aggressive short-term volatility is likely a given. 5. The index breaks above and doesn't retest the previous all-time high. This of course is not likely, but it still remains a theoretical alternative, one that we just cannot rule out. This outcome would be of an exceedingly bullish nature and you'd want to get in on it as early as possible. Enough said. 6. The index reaches the all-time high and shifts from being above and below its horizontal support and resistance level. This one is quite an interesting one, for this is exactly what happened in 1998. It is also how the US Nasdaq behaved before shooting up recently. Now, the technical similarities between the 1998 unfolding of events and the current corona recovery are fascinatingly alike. In fact, they're rather copy-paste in nature. We're talking the steep decline, the steep recovery, and the RSI behavior at which it for long hovered around just at or below the upper bearish blue prior to going parabolic. So whoever said that history doesn't repeat itself might need to eat those very words if this parabolic scenario were to unfold in full. What fascinates me in this case is how teasingly the index price acted and danced and twirled around the previous all-time high. For as we can see, it broke above and then broke right back below again, still licking the support and resistance line from below, upon which it broke above once again and then made a nice solid balancing act on the all-time high support line prior to shooting up some 88% in little less than 5 months. A similar move would, for example, land us at around 33.55 if we were to apply the same fib extension targets as that of the succeeding exponential move of 1998. This would amount to a 75% parabolic increase should history repeat itself. Not bad at all. And in such case, small and mid-cap stocks are where you'd want to be at. Those often dubious companies rarely get a chance to shine. However, parabolic wave 5s are their 15 minutes in the limelight. But do make sure to get out on time, or else you might find yourself in bankruptcy. But we'll cover that once we get near. If we get there, that is. So, now that we've gone through the various outcome possibilities, what then are you meant to do with this information? Well, nothing, for this is not financial advice. What I can tell you, however, is what I'll do myself. And if you want to copycat me, then that's on you. Now, needless to say, I won't take any new long positions once we get near the all-time high, at least not before we have broken above and closed above it. This of course presumes that the individual stocks themselves will have had technically confirmed outbreaks too. And this is important, so listen carefully. If the index were to retrace back under the all-time high again with a few percent safety margin, thus confirming some sort of a fake out, I will pull the catapult to release my position in an instant. The reason behind this is simple. For whenever you get a false outbreak, a fake out, whatever you want to call it, prices tend to reverse aggressively in the other direction. Fake outs are the ultimate sadistic agony that can be afflicted upon any clueless trader or market participants, because it always tends to catch them off guard. In such cases, they're typically still in a state of excitement from the original breakout, and once the fake out occurs, they immediately enter a paralyzed state of denial. We saw it during the corona panicky waterfalling that denial at the market is counterproductive, but most of all, it's incredibly expensive. To neatly sum this episode up, I will buy high-octane small and mid-cap stocks down to the last penny upon any closing above the index all-time high, as I expect a parabolic move. This of course given that the individual stocks have had their technical outbreaks too. And if the index were to close below the all-time high with enough margins, I'll sell it all right away. This procedure I'll then repeat as many times as it takes until the index makes up its mind about what side to stick with. That was all for now. Thank you and goodbye.